Chapter 5. International Banking Risks. Under this chapter, we will cover the introduction to international risks. Types of international banking risks. Internal risk assessment of international banking. And supervision and regulation on international banking. End of this chapter, you should be able to differentiate the various risks in international banking. Explain how to manage international banking risks. And identify the types of supervision and regulation imposed on international banking. Part 1. Introduction to international risks. Introduction to international risks. Risk is an uncertainty. Risk is defined as the chance that an investment's actual return will be different than the expected. This includes the possibility of losing some or all of the original investment. Risk can come from different ways. It is important to understand the risks faced in the banking, as this understanding can be used to manage the risks. Managing risks can limit the probability of bank failure. International business risk is defined as the possibility of loss caused by some unfavorable or undesirable events in international business operations of banking and financial institutions. The main causes of international business risks are the changes in the international environment, the differences of economic systems, objectives and cultures of different countries. However, the degree of such risk is not the same. It depends on the institutions and countries. Hence, risk management is vital in managing risks. Risk management can be defined as a structured or systematic framework about identifying, coordinating, evaluating, sorting, prioritizing, monitoring and controlling the probability or impact of unexpected events. Why risk need to be managed? It is because we cannot have a zero-rate risk level, but at least we can minimize its impact if it happens. Types of international banking risks. There are 9 types of international risks. First, operational risk. Second, market risk. Third, credit risk. Fourth, interest rate risk. Fifth, foreign exchange risk. Sixth, sovereign risk. Seventh, liquidity risk. Eighth, transport risk. And ninth, cultural risk. Operational risk is the risk of direct or indirect loss resulting from inadequate or failed internal processes, people and systems, or from external events. There are 2 key elements in the definition. First, the focus is on internal factors, which banks can, and should shape, control and influence. This includes losses or breakdown caused by inefficient management, by physical causes, by personnel failure, misleading information, from liability for accidents, and due to mismanagement of business ventures. Second, external aspects, such as market environment, credit situation, and other risk condition. Market risk. Market risk is the risk of losses in on- and off-balance sheet positions, arising from movements in market prices or rates, including interest rates, exchange rates, securities prices, and commodity prices. There are 2 types of market risk. First, systematic market risk. The systematic market risk is caused by a movement in the prices of all market instruments due to macro factors such as a change in economic policy. Second, unsystematic market risk. The unsystematic market risk is where the price of one instrument moves out in line with other similar instruments because of events related to the issuer of the instrument, for example, lawsuit against the issuer. Credit risk. Credit risk is defined as the probability that a loan will not be repaid, or there will be a default in payment. Another definition for credit risk is the potential that a bank borrower or counterparty will fail to meet its obligations in accordance with agreed terms. Generally, credit risk is associated with the traditional lending activity of banks, as it is simply described as the risk of a loan not being repaid in part or full. Due to the fact that the default in payment phenomenon was in a rising mode, Basel I primarily focused on credit risk, where banking and financial institutions were required to maintain their capital level equals to 8% of risk-adjusted assets. Thereafter, Basel II has revealed many loopholes in accurately managing credit risk during the financial crisis. As a result, Basel III had to provide more effective regulations about addressing credit risk, by determining the several shortcomings and ambiguities present in Basel II. Basel I, II and III are the Basel Accords. The three series of banking regulations set by the Basel Committee on Bank Supervision, BCBS. The accords are designed to ensure that financial institutions have enough capital on account to meet obligations and absorb unexpected losses. Interest rate risk can be defined as the exposures of a banking and financial condition to adverse movements in interest rates. The bank makes profit by paying a lower interest rate on its liabilities than it earns on its assets. The difference is called net interest margin. In terms of period of time, its liabilities payments are usually shorter than its assets. The interest rate paid on deposits and short-term borrowings is sensitive to short-term rates, while the interest rate earned on long-term liabilities is fixed. This creates interest rate risk, in which the risk that interest rates will rise cause the bank to pay more for its liabilities, thus reducing its profits. Foreign exchange risk is also known as currency risk or exchange rate risk. Forex risk is a financial risk that exists when a financial transaction is denominated in a currency other than the currency of the origin country. International banks trade large amounts of currencies, which definitely will expose them to forex risk, for example the depreciation of currency value in respect to another. Sovereign risk is sometimes refers to political risk. Many foreign loans are paid in USD and repaid with dollars. Some of these foreign loans are given to countries with unstable political environments, which may threaten foreign investments, FDIs, where the investors will pull out their investment to prevent losses arising from sovereign risk. Political risk has an adverse effect on any economy. It affects international banking and financial institutions' behavior. Unstable political environment can include changes in government policy, taxation policies and law, and etc. Liquidity risks arises when bank has to meet its obligations as they come due, without incurring losses. There are two types of liquidity risks. First, funding liquidity risk, which occurs when a firm is unable to obtain sufficient funds to meet cash flow obligations. Second, market liquidity risk, which refers to the inability to conclude a large transaction near the current market price. Few studies believe that liquidity risk may be minimized by enhancing domestic banks' size and minimizing debt-to-equity ratio. Transport risks. Due to long distance between countries, goods are dispatched by shipping or airways. Sea and land transport are exposed to many types of additional risks. Cultural risks. Culture differs from one country to another. As a result, a business firm faces additional risks. Examples of cultural risks are, differ in language, customs, lifestyle, and value of time between countries. Internal risk assessment in international banking. Bank internal risk assessment models. First, credit scoring system. The traditional approach. Credit scoring system can be found in virtually all types of credit analysis, from consumer credit to commercial loans. It is essentially to pre-identify certain key factors that determine the probability of default, and combine or weigh them into a quantitative score. The score derived from credit scoring analysis is interpreted as a probability of default. The score can be used as a classification system. It places a potential borrower into either a good or bad group. The second bank internal risk assessment model is value at risk. The modern approach. Value at risk seek to measure the minimum loss of value on a given asset or portfolio over a given time period, at a given confidence level, either 95%, 97.5%, or 99%. Value at risk is powerful in assessing the risk exposure of a portfolio of assets because it takes into account the correlation among different assets. Credit derivatives are designed to transfer the credit risk on portfolios of bank loans or debt securities from banks to non-banks, particularly insurance companies. There are 4 individual instruments. First, credit default option, CDO. Second, credit default swap, CDS. Third, credit forward agreement, CFA. And fourth, credit securitizations. Credit default option, CDO, is an option to buy protection, or sell protection, as a credit default swap on a specific reference credit with a specific maturity. A credit spread or net credit spread involves a purchase of one option and a sale of another option in the same class and expiration, but different strike prices. Credit default swap, CDS, is a financial swap agreement that the seller of the CDS will compensate the buyer, which usually the creditor of the reference loan, in the event of a loan default by the debtor, or other credit event. Seller of the CDS insures the buyer against some reference loan defaulting. The buyer of the CDS makes a series of payments, which is CDS fee or CDS spread to the seller, and in exchange, the buyer receives a payoff if the loan defaults. In the event of default, the buyer of the CDS receives compensation, usually at the face value of the loan, and the seller of the CDS takes possession of the defaulted loan. Credit forward agreement, CFA, hedges against an increase in default risk on a loan or decline in credit quality of a borrower after the loan rate is determined and the loan has been issued. The CFA specifies a credit spread, in which a risk premium above the risk-free rate to compensate for default risk on a benchmark bond issued by the borrower. Credit securitizations refers to the complex process of transforming individual loans into assets that may be purchased by investors. Banks coordinate these transactions to reduce their exposure to individual financial risks. Meanwhile, investors prefer the securitized products as means to diversify their respective portfolios and gain entry into multiple financial markets. The misuse of the securitization model may create asset bubbles that inevitably collapse. Supervision and regulation on international banking. Banking crises, rapid structural change and continuing globalization, liberalization and integration of international banking have led national and multilateral policymakers to focus increased attention on the crucial role of banking supervision and regulation. Policy discussions specifically focus on several issues that must be addressed in establishing and maintaining effective supervision, including who should supervise, monitor, and control banks. The three issues need to be addressed by the policy makers with respect to the structure of bank supervision are: first, whether there should be a single bank supervisory authority, or multiple bank supervisors. Second, whether the central bank should play a role in bank supervision. And third, whether the supervisor responsible for the banking industry should also have responsibility for other financial services, such as the securities and insurance industries. Approaches in supervisory and regulatory of international banking to secure the best way of carrying financial and banking responsibilities. Approaches in supervisory and regulatory of international banking. First, single bank supervisor or multiple bank supervisors. Second, bank supervisory role of the central bank. Third, scope of supervisory authority. Fourth, supervisory approach of countries. Fifth, anti-money laundering, AMLA, regulations. Sixth, the Basel Committee on Banking Supervision, BCBS. Seventh, offshore financial centers, OFCs. Eighth, banking and the World Trade Organization, WTO. And ninth, Islamic banking supervision and regulation. Single bank supervisor or multiple bank supervisors. A key policy decision in designing the framework or structure of the bank supervisory system is whether there should be a single bank supervisory authority, or multiple bank supervisors. Single bank supervisory authority, or multiple bank supervisors, both have its advantage and disadvantage. Those choose for single bank supervisors have the reason of fear of a competition in laxity between multiple bank supervisors. Meanwhile, those who choose multiple supervisors have the reason of benefits of a competition in ideas among multiple bank supervisors. Bank supervisory role of the central bank. countries must decide whether to assign responsibility for bank supervision to the central bank. There are advantage and disadvantage of central bank being a bank supervisor. The advantage is, as a bank supervisor, the central bank will have first-hand knowledge of the condition and performance of banks. Thus, this can help to identify and respond to the emergence of a systematic problem in a timely manner. Meanwhile, the disadvantage of assigning responsibility for bank supervision to the central bank is the inherent conflict of interest between supervisory responsibilities and responsibility for monetary policy. This conflict can be critical during an economic recession, in which the central bank may be drawn to pursue a too loose monetary policy to avoid adverse effect on bank earnings and credit quality. Scope of supervisory authority. Financial conglomerates that operate in the banking, securities, and insurance sectors are among the most powerful multinational corporations in many countries. Some argued that the supervision by the conglomerate with broad scope to cover all financial services is necessary for effective supervision, and in particular, supervision by such conglomerates is not fragmented, uncoordinated, or incomplete. Some argued against the supervision by conglomerates by highlighting an undue concentration of power that would otherwise be dispersed among several agencies. Thus, this could increase the likelihood of regulatory capture and retard financial innovation. Supervisory approach of countries. This is the approach in which the supervisory authorities supervise banks is quite important. If there are banking regulations, but no authorities to enforce it, thus, it becomes meaningless. It is important to have the supervisors that have a direct contact with banks, therefore represent the main line of defense against unsafe and unsound banking practices. The issues of the scope of supervision are whether the bank supervisory authorities also have responsibilities for non-banking industry, for instance, securities and insurance firms. Whether bank supervisory authorities are independent from political influence. Whether bank supervisory are exposed to excessive risk that could affect their level of capital. Indicators of supervision's effectiveness are: first, enforcement powers. Second, the degree of disclosure supervisory authorities must comply with. Third, the independence of supervisory authorities. Independence refers to whether or not the supervisors are legally liable for their actions. Anti-money laundering, AMLA, regulations. Money laundering is defined as an act or a process of transforming profits earned from a criminal or illegal activity into legal profits. Examples of money laundering is money earned from drug trafficking, arms smuggling, nuclear secret and etc. There are 3 stages of money laundering. First, placement, which is the placement of currency into banks and financial institutions. Second, layering, which move the money from one bank to another, in order to disguise the original source and ownership of money. Third, integration. After money have been laundered, it will be used for legitimate business. The prevention measures of AMLA. First, develop a customer acceptance policy and procedures to address the establishment of business relationship with customer. Second, conduct customer due diligence or reasonable care, and obtain satisfactory evidence in their records, the identity and legal evidence thereon. Third, keep all records and documents of transactions for at least 6 years, and ensure the retained documents are able to create an audit trail. Fourth, shall conduct ongoing customer due diligence on their economic background and purpose on any transaction. Fifth, promptly submit a suspicious transaction report to the Financial Intelligence Unit in Central Bank. Sixth, appoint 1 or more officers at the senior management level, to be the compliance officer who responsible for the submission of suspicious transaction report to the Financial Intelligence Unit in Central Bank. Seventh, provides training and guidance to staff in the operation of procedures and controls relating to money laundering. The Basel Committee on Banking Supervision, BCBS, is a committee of banking supervisory authorities that was established by the central bank governors of the Group of 10 countries in 1974. It provides a forum for regular cooperation on banking supervisory matters. Its objective is to improve understanding of fundamental supervisory aspects and increase the quality of banking supervision worldwide. Offshore Financial Centers, OFCs. International Monetary Fund, IMF, suggests a more practical definition of OFCs. OFCs is a financial system with external assets and liabilities out of proportion to domestic. OFCs act as a financial intermediation. OFC is a financial institutions that engaged primarily in business with non-residents. OFCs have the provision of some or all of the following services, which includes low or zero taxation, moderate or light financial regulation, and banking secrecy and anonymity. Banking and the World Trade Organization, WTO. The WTO General Agreement on Trade in Services, GATS, and its Annex on Financial Services, Annex, took effect in 1999, specifying the general principles that govern cross-border trade in financial services. The GATS and the Annex also specify the restrictions that may be imposed on trade in services for prudential purposes by the current 161 WTO member countries. Islamic banking supervision and regulation. The fundamental features of Islamic banking include prohibition against the payment or receipt of a fixed, or predetermined rate of interest, riba. Use the concept of profit and loss sharing, PLS. Rate of return can be determined only ex post, on the actual profit from the Sharia-compliant real sector activities. Requirement to operate through the Islamic base of financing, which affect both assets and liabilities sides of the bank's balance sheet. 5 essential elements in Islamic contracts that need to be fulfilled are buyer, seller, asset, price, offer and acceptance. Investment deposits are not guaranteed in Islamic investment. If investment experience losses, depositors may lose part or all of their investment deposits. Contractual agreement based on the pre-agreed ratio for profit and loss distribution, between depositors and banks. 2 systems of Islamic banking operation. First, 2-tier Mudaraba. Second, 2 windows. Under the 2-tier Mudaraba, assets and liabilities sides of a bank's balance sheet are fully integrated. On the liabilities side, depositors enter into a Mudaraba, a profit-sharing contract with the bank to share the overall profits accruing to the bank's business. Thus, depositors act as capital providers or financiers by providing funds, and the bank acts as an entrepreneur. On the assets side, the bank enters into Mudaraba contracts with agent entrepreneurs, who search for investable funds and agree to share profits with the bank according to a certain percentage stipulated in the contract. In addition to investment deposit, banks are allowed to accept demand deposits that yield no returns and may be subject to a service charge. Under the 2 windows arrangement, bank liabilities are divided into 2 windows, one for demand deposits and the other one for investment deposits. The choice of the window is left to depositors. Demand deposits are assumed to be placed as safekeeping. Thus, it is considered to belong to depositors at all times. Bank cannot use it as the basis to create money through fractional reserves. And banks must apply a 100% reserve requirement ratio on demand deposits. Meanwhile, investment deposits are used to finance the risk-bearing investment projects with depositors' full awareness. These deposits are not guaranteed by the bank and reserve requirements are not applied to them. The bank may charge a service fee for its safekeeping services. We have completed Chapter 5. Please read the textbook for detailed explanation. Thank you.